So last week we walked you through our goldfish analogy. We're going to focus on the fishbowl part of that this week, i.e. growing your wealth and how to do it following a process, sound philosophies as opposed to prognostications, what exactly that means and what opportunities may be opening up for investors following some of our favorites. So first of all, thank you for all the positive feedback to the goldfish metaphor commentary last week. Always welcome your feedback, even if it's not good. Happy to take constructive criticism or ideas for future commentaries anytime. This week I thought I would focus a little bit on that metaphor again, but on the fishbowl. So I mentioned that there are just these set long-term averages that apply to the growth of that fishbowl. And so that's again why you want to focus on the size of your budget, the fish, because you can only do so much with that bowl. But there are things you can do, and there's certainly things that you can avoid. So we're going to talk through some of that this week. I'm going to try to make it punchy, hit you with some facts that you may not have known. So let's get started. First of all, why do we preach diversification all the time? It isn't just because it sounds good. We got it in a textbook. It's because if you look back at market history, it's going to smooth out your volatility, which is going to help you from an emotional standpoint. If you're properly diversified, meaning things are acting differently, there should be some part of your portfolio that's doing well, even when there will be other parts that aren't, and that requires some patience too, to help you in case of emergency cash needs or things of that nature. But the other reason is that, as odd as it seems, when you look at things working and not working within the portfolio, if you look at a globally equity diversified portfolio over time, it's outperformed. Now, depending on who's done the study and exactly how they've allocated it, it could be anywhere from 2 to 3%. But if you look back over the last 50 years, that global equity diversified portfolio has consistently outperformed the S&P 500, given enough time. And that 2 to 3% adds up to big money. It could be 2 to 4 times greater total return, again, over that type of a time frame. So it is about performance. It isn't just about trying to mitigate losses, and a very powerful and important truth that people don't know. Here's another thing. When we're talking about things working and not working, clearly the S&P 500 has been working here in recent years, but a stat that catches a lot of people off guard in a world that's increasingly focused, if you look at fund flows on the S&P 500, is again just how historically asset classes in the global equity domain have performed. The S&P 500 over this 49-year time frame, we got this information from our friends at Dimensional, has only been the top performing equity asset class once over that time frame. Conversely, it's been the worst performing asset class 14 times. I think that catches most of us as U.S. investors, particularly if we've only really been investors over the last 10 years, as I know many of our clients have been, off guard. The second truth behind why you want to be diversified, though, is the power of mean reversion, is those things that you're about to give up on are likely to have their day in their sun. And if we look at, again, the power of mean reversion, some interesting things pop out. First of all, if you don't believe in mean reversion, i.e. that averages don't happen with regularity, we've got an important singular fact that I think sums it up really well. Despite having a 9.5 to 9.9% average since 1926, depending on who you want to talk to, in the S&P 500, you've got an 8 to 10% return in a calendar year exactly 0 times. So that means you're either coming from above or you're coming from below. But again, for those people who are looking at their statements, hoping to see average, it's only going to play out over time. And so again, we share that to again, give it patience, let it see, and also don't get too greedy at the top, which has been more of a threat here in recent years. So what types of things might be mean reverting, and we'll wrap it up. If you look at value stocks here in the US versus growth stocks, again, the FANG stocks have been leading the way: Facebook, Amazon, Apple, Netflix, Google. Historically, value stocks have actually outperformed growth stocks over rolling 10-year time frames 83% of the time. Only 14 times over these rolling 10-year time frames of 82 sets have you seen growth outperform value? And yet 8 of those 14 have occurred just this decade. It's virtually unprecedented. Again, for those who believe in mean reversion, as we certainly do, it's something that isn't just interesting, it very well could be an investment thesis that could pay off if appropriate for investors here over the next 5 to 10 years. Another one, looking at international domain versus US, is emerging markets. I can't think of an asset class from an equity standpoint that's been more out of favor. But if you look at where things sit today, and this comes from a paper from Wisdom Tree that I read on the flight over, 61 times you've seen this type of a spread, and of those 61 times, 89% of the time, emerging markets has outperformed the S&P over the next 5 years. And not just kind of outperformed, drastically outperformed by an average of 18.7 annualized rate of return compared to 3.9 for the S&P 500. So in conclusion, we do not have anything against the S&P 500. It has been, I'm sure will be, our largest position for most investors. What we're encouraging you to do, again, is to embrace diversification, embrace historical perspective. It'll give you the patience to see through all the different types of weird markets that, again, are actually the norm when it comes to equity investing, to give things time to play out, to not buy high, and thus give your bull the best chance of growing in terms of those long-term averages for equity investors that you possibly can get. With that, we'll wrap it up. Thanks so much for joining us once again.